We're going to go ahead and do a full technical analysis for Bitcoin and Ethereum today. We're going to be discussing reversal points, how far Bitcoin can move up, how much room it has to the downside, and of course, what our expectations are for 2023 onwards. Let's go ahead and dive into today's video. Okay, MegaWhale team, welcome back to the channel, guys. Thank you for tuning into today's video. I hope you're all having a fantastic day. We're going to go ahead and talk about Bitcoin and Ethereum today. We're focusing on the smaller time frame and the larger time frame today, but more importantly, tuning in on the technicals, talking about the strength of the trend, reversal points, and price predictions. Before we get started, head down to the pinned comment, click the link to join our Telegram channel, get updates on all of our analysis, information, charts, videos, and so much more over here, guys. If you're interested in VIP, you can of course contact me via here to find our monthly results and the membership details to find out more about our VIP channel. And obviously, smash the comment section, and hit that subscribe button if you're new to the channel. We do daily updates focusing on technicals only, focusing on analysis of Bitcoin and other cryptos. Let's go ahead and dive into it. So we'll get started with the usual stuff, which is the data. And what we're seeing here is something very interesting. We are officially in the fourth quarter for 2022, obviously, but something very interesting, guys, is Bitcoin has never had 4 quarters in a row be red. If this quarter closes red, this will be the first time in history Bitcoin has seen 4 consecutive red quarters. We have seen a few before, but never have we ever seen 4. We usually see around 2 at max, but 4 is the most we've ever seen. If we move to the monthly chart right now, we can see Bitcoin is negative 17.74, meaning that we come up a little bit in price, around 1% since yesterday. Still not a lot of volatility in price action. It's still hanging around that same 1 or 2% range we have been in the last few days. Volatility, as you can see, for a 30-day period is 4.1, and 4.1 is relatively high. 4.1 is definitely relatively higher. It's on the higher end of the average. But if we go ahead and zoom in, this is where it gets interesting. You can see in the last couple days, or should I say the last 8 days, volatility has pretty much been hanging around as 4.1 this entire time, meaning although the 30-day average for volatility is quite high, the last day-to-day range for the last 8 days has been basically nothing. There's been basically no change. It's been pretty much around 4.1, meaning the overall volatility in the last week has been relatively low. And we've seen that according to the price action. If you look at the last week of price action, the price action hasn't been too intense. You know, we've seen some big wicks down, up, but more or less we are pushing in this sideways consolidation, which we'll talk about later in the video. Moving on, of course, liquidations very low for 24 hours, indicating again, not a lot of people is trading this range, and it is quite common when we see low volatility, particularly day-to-day, intraday volatility. We generally have relatively low liquidations as well, as less people are in the market, less people are trading, and therefore less people are being liquidated. Okay, so it's quite indicative. They kind of go hand in hand: low volatility, low liquidations. Okay. Let's go ahead and talk about the broader market. So the DXY did actually break out of this descending wedge formation it was developing. We broke up into the 107 range. We didn't quite get high enough to retest this resistance here, but we did see a nice rally on the DXY over here. And this could be the start of a move upwards. Unfortunately, it has come down and it has failed to hold, it seems, this 106.63 level. Now, we'll come back and talk about it in a second. As we already know, generally, the DXY is inversely correlated to stocks and crypto. We've seen crypto behave a little bit more sporadically, and it's been detaching itself a little bit from that correlation in comparison to stocks over the last few weeks, particularly ever since the FTX drop. Generally, when we have news events, they can trigger prices to move against their correlations with the rest of the markets. That is kind of what we're seeing for Bitcoin. But if we take a look at the DXY now and we go and look at the stock market, which we'll do in a second, you can see the DXY went upwards, and we saw stock markets take a little bit of a tank. Okay, we saw the Dow Jones move down a little bit, and now the DXY has gone back down. We've seen the Dow Jones recover a little bit, and the same thing can be said about the S&P 500. Again, on the smaller time frame, we saw that decline, and now it's kind of pushed back up. What we are seeing on the S&P 500, we'll come back to in a second, is a rejection from the $4,000 level. And the $4,000 level is that major horizontal psychological resistance that we do need to break for a move upwards. If we get above this level on the daily chart, we will be making a push to retest this downward trending resistance. The next big rejection zone, of course, acting as that bear market resistance. Breaking through this would officially mark the end of the bear market for the S&P 500. That does not mean we'll be entering a bull market. It doesn't mean we'll be entering an uptrend. All it means is we've broken out of this downward consolidation, which is what this bear market is, a downward consolidation, okay? It's not the end of the world. Bear markets don't mean destruction, death of Bitcoin. Those mean these long drawn out periods of downward price action, followed by long drawn out periods of upward price action. Markets move in cycles. Going back to the Dow Jones, we can see a very similar thing, guys. The difference is the rejection point is at this $34,000 level, which again is that major horizontal level, as we can see over here. Again, not too much has changed over here. Looking for a daily break over here for a move up to 35,000. And of course, that level being that bear market rejection point, sending us up into a new trend. Bond yields haven't changed too much. We're not really going to talk about those today. And of course, Bitcoin dominance has made a nice move upwards in the last couple of hours. And again, as Bitcoin dominance rises and the total cryptocurrency market cap either remains the same, which it has, or falls, we are going to see Bitcoin kind of move upwards when altcoins are either moving sideways or moving downwards. And that's kind of what we've seen in the last 24 hours. So let's go ahead and get into the short term for Bitcoin. And then we'll go ahead and get into short term for Ethereum. And then we'll go ahead and do our macro analysis and technicals. So what are we looking at from a structural standpoint, first and foremost, for Bitcoin? This is what we're seeing. We saw a break out of to the upside of this bearish pennant, okay? And this is a bearish pennant. First and foremost, we have lower highs, okay? Followed by higher lows. So we have an instant triangle formation, okay? So a pennant formation is generally the same as a symmetrical triangle. The difference is they generally last around a week, around 2 weeks, usually not longer than 3 weeks. Anything above that is generally considered a symmetrical triangle. Also, symmetrical triangles generally have more sporadic price action between the trend lines, meaning we generally see a lot more retests of these trend lines than what we've seen in pennants. We usually have much more clear swings in pennants than we have in symmetrical triangles, which could very much just be like this, okay? We could see a lot more sporadic price action, a lot more retests in these symmetrical triangles. The reason it's a bearish pennant is because we entered from the top side in. So generally when we enter from the top side in, we see that trend continue through the pennant. Not always, all right? It's not, nothing's a guarantee in trading, but based on historical probabilities, we are more likely to see that. In this scenario, we've actually seen a break to the top side. So that doesn't invalidate anything that's happened here, but it does make us aware that this trend line now has been broken, okay? This uptrending diagonal trend line now is now now we can kind of delete this trend line, but what we can say for sure is this uptrending support line here is now going to be acting as a continued diagonal support. Because as we already know, guys, diagonals don't just disappear. They kind of remain valid for a good duration of time. So we can extend this as a support now. What we're looking at here is a horizontal support range sitting around 16,800, which extends up slightly to 16,830, which you can see on the smaller time frame. We actually are currently retesting that. You can see on the 5-minute chart over here, we've dropped into it. And we've just bounced with a small little green candle, nothing too significant yet. But again, this is a support level. Breaking back below the support level will trigger a move towards the support line again, where we will test that support line and see if we hold it or fail to hold it. Breaking below the support line sends us back to these lower targets, okay? Alternatively, breaking up past this first green line here, closing above that on an hourly, will propel us up to these higher green targets on the time frame, okay? Very, very unlikely we see a very aggressive move up here. It is possible, but again, it is unlikely according to the market structures. But when we do analysis, there are two things we need to look at. We need to look at market structures and we need to look at technicals. So let's go ahead and take a look at some of the technicals. We'll go ahead and delete everything off the chart. So we know our zones that we've already talked about. We've inputted those horizontal zones. We've got those levels on the chart already that we're looking at. Let's go ahead and take a look at some of the technicals. So market ciphers, let's take a look at the moving averages. We'll start on a 4-hour, so we're doing a smaller time frame for now. So what we are seeing here on the 4-hour is a classic, very, very classic reversal pattern. It's called an expansion compression pattern, okay? Where we have expansion after a significant volatile move down. It usually happens after these volatile moves. So as you have a more drastic or sharper move in any direction, it is natural to see the price action expand away from your larger time frame moving averages. Okay, this is of your 50 EMA, so it's a medium time frame moving average. But as we see this volatile price action moves, we generally see expansion away from moving averages. Expansion determines volatility, or what it depicts volatility. So the more expansion between the price and the moving average, the higher degree of volatility we can actually assume. So right now, this is like peak volatility over here, very high volatility. And as we start compressing, it means volatility is starting to move down. With volatility moving down, we have compression, okay? Now, we can confirm that. Because if we look at the last 8 days on the Bitcoin volatility chart, we have seen a plateau in volatility. Let's go ahead and look again, okay? There's a very clear plateau. Let's just drag it across, sorry. Here it is, a very clear plateau in volatility. And again, we can see that on the chart that we're looking at right over here, and as expressed with the pinching or the compression between the moving averages and the price action, indicating again, lower volatility. So we don't even need to look at the volatility chart to actually know that the volatility has dried up in this region. We have this compression, okay? So with compression, we generally have increased volatility again. It goes from expansion, okay, to compression, okay, and then compression over here, sorry, expansion, and then it goes back into expansion, okay? So we're generally followed by a more heavy move to either direction. Usually the move that we make is a directional break of the EMA. So if we're looking for a break over the EMA over here, we generally see a continuation in that trend. Here's the thing, guys. Where is that 50 EMA resting on the 4 hour? Well, by no surprise is it resting around 7,200, a little bit under, but definitely above 17,000, sorry. So 17,000 being that major trigger zone for a retest of that 50 EMA, and that being that major break for a continuation upwards. Where can that potentially take us? Well, we'll be looking at previous levels of major support. So we go ahead and draw our chart backwards a little bit. Let's go ahead and see where that can potentially take us. Obviously, we have cleared this level over here. So 17,600 being that low. Moving upwards from there, we have areas like 18,600, which was a major rejection point and trigger point on the last move down, which was over here. And obviously, if you remember on the chart, we had a lot of support along this level, even wicks down below, and obviously finally triggered that break to that low over here. Remember back to our horizontal range, which was over around this level over here. We were talking for a very long time that 18,600 is that major trigger for a move down to 17,600. When we lost the 18,600 level, we saw that very explosive move back down. Therefore, that is a point of concentration on the chart, a point of confluence, and an area in which we can expect the price to eventually retest if we form some sort of uptrend. So if we do happen to break through these levels, we can expect a move to here as a maximum, okay? As a maximum, that would be the next move. As a minimum, we'd expect 17,600, okay? That is provided the 50 EMA breaks. On the downside, guys, moving through the downside, we've already talked about what happens there. We are more focused on structural patterns for the downside right now, as the moving averages and the technicals are now pricing in this lower volatility zone, which is consolidation. So they are going to be representing either consolidation or a potential move to the upside. If we go to the larger time frame, we can then see more of those bearish indicators pop up. But on the smaller time frame, they are going to start suggesting a little bit more potential move to the upside as we get this compression in the moving averages. For the downside, of course, we do have this uptrending support line. We do have this bearish pennant formation, which we'll break out of. We can do a very simple measured move analysis, break that down over here. It'll take us to about sub 15K, okay? So the measured move takes us to about sub 15K. If we go to our larger time frame chart and bring up our VRPV in a second, you will see that if we go below that previous low that we did create at around 15,500, we do expect a continued move down towards that 13.9, potentially even lower. So we do have basically no support below us now. This is our last line of support that we've created around about 16,600, which happens to be that uptrending support line. Okay, if we lose that level, we are heading down into these depths where we have these peaks again in the VRPV. The first one sitting at around 13,900. As you can see, we have that small little peak over here after this little dip. okay? And the next major ones are sitting down at around 12,000. So we do have one last leg of support essentially, which we have developed in the last few days. Losing that level will take us lower. So that's a short-term analysis of Bitcoin. Let's go ahead and take a look at Ethereum. Looking for an honest, reliable, and accurate exchange that you can trust to trade on, go ahead and sign up to Bitget with the link down below and join myself and all of our other VIP members and other members who trade on Bitget daily. There's a whole range of benefits and features you can actually get by trading on Bitget. These include no government regulations, meaning you can sign up from anywhere in the world. There's no KYC, 0% trading fees on spot, massively reduced trading fees on futures. It's one of the lowest in the game. And most importantly, access to their protection fund in case the exchange gets hacked. You can actually get reimbursed for your funds, so you can ensure your funds are safe. Now, most importantly, if you do sign up with the link down below, that first link, you'll get access to 2 additional features. These include access to a reward center where you can get up to $4,163 in rewards, and access to the MegaWhale exclusive referral link, bonus discounts. Every other month we do bonus campaigns. We get up to 10% off your trading fees, or even you get a percentage of your trading fees refunded to your account as USDT. Essentially, you get paid to be on the exchange. That's enough, guys. We'll get back into the video. Now, Ethereum is looking a little bit different. We'll take a look at the macro to start off with. On the smaller time frame, we'll get into a second, we are seeing a similar pattern for Bitcoin as what we are seeing on Ethereum. But the larger time frame for Ethereum suggests 2 things. First and foremost, we have this downward trending channel, and this is our bear market, okay? This is our bear market downtrend. This is the bear market consolidation, the downwards consolidation in the bear market. Therefore, we're looking for a break above this trend before we look for any long-term entries for Ethereum. Breaking above this trend will suggest that the macro bear market has been broken. Again, it doesn't mean we're in a new uptrend. It just means the macro bear market trend has broken. It means we're developing, or have a chance to develop, a new uptrend. Again, we can see fake outs and push back down, and that is why we have to wait for these reversal points. Okay, so what we're seeing there is that what we're seeing on the smaller time frame, of course, we zoom in, we are seeing a larger time frame pennant here, and the measured move for that larger time frame pennant, of course, if we take breaking to breakdown point, it could take us a pretty significant move down. Obviously, that is not realistic, but we go ahead and make that a measured move, 63 to 63. Another 63% move could take us down to this low 400 range. Now, why is that important? Because that low 400 range for Ethereum brings us to the same kind of range of which we will see Bitcoin reach. If you take a look at these peaks over here, that is that 13,900 peak where Bitcoin was in September 2020. So it will take us to around that same level if Bitcoin does see a significant move down. Do I think it's likely? I don't know. It's very hard to say. We are waiting for those technical confirmations. So for a move down for Ethereum, we are expecting a break of this level. Breaking that level, we'll see a continuation downwards. Again, just because the measured move says we can go down over here, it doesn't mean we will actually go down over there. It's a measured move, meaning that is the maximum drawdown range we can expect from breaking out of this larger time frame symmetrical triangle. Just because it's a low volume range, again, it doesn't mean we can't actually develop brand new supports or potential bottoms in this range. As we have these low volume ranges, that is where we are most likely to develop new supports, as we have just seen on Bitcoin develop a support at 15,800, which prior to this move was not even there. Okay, on the smaller time frame, it is looking quite similar to Bitcoin. We do have a pennant formation again on this pattern over here, this uptrending support line, and of course a downtrending support line. For Ethereum, we haven't actually seen a breakout yet, but again, we can do a similar analysis. So the measured move for this pattern, again, we're looking for touch to touch. We can move that down. It's around 25. We're looking at around 950 for a breakdown on that. Of course, that would break down through this uptrending support line. And again, on the 4-hour chart, let's see if we had that expansion compression, sorry. We do have a similar expansion compression going on for Ethereum, but nothing as strong as what we're seeing on Bitcoin. Okay, so the short term for Ethereum, very much similar, guys. If we do break out of this pattern, we are expecting a retest of the 50 EMA. The 50 EMA retest will take us up to these levels. Okay, so 12,680 being that previous low rejection point, and of course that's an incredibly strong rejection point, guys. If we are able to break above there, we'll have to do another analysis, but it's very hard to say where it can take us after that. We're looking at higher levels, 13,360, potentially even higher, okay? But right now, again, a lot of negative pressure over here, a lot of compression, low volatility, a lot of resistance, and we're in a bearish pattern. Ethereum is definitely not looking as full of potential as Bitcoin. Bitcoin's definitely looking like it's got a little bit more potential here than Ethereum, but as we said already, if Bitcoin if it cannot get above 17,000 to 17,200 as per, let's go back to it, as per this chart over here, if it can't really stay above these levels here and push through here, it's not really going to make any move to the upside. It's more likely to come back down, okay? Something to keep in mind for that one. Let's go ahead and look at the larger time frame. So this is the larger time frame for the monthly. Let's go ahead and drop it down to the weekly. That should be the weekly. And let's run some technicals. So first and foremost, the one that everyone is most looking for, of course, what we're all looking for really is that RSI break. And we did see the RSI break on the weekly, but unfortunately it was a very, very slight break, and we kind of had that fake out. If we go back to the total cryptocurrency market cap, you can see that we did have this similar breakout on the total cryptocurrency market cap over here on the downward trending resistance, but it was a fake out. If you remember the 2-day chart, the retest of the 50 EMA on the 2-day on Bitcoin, again, a fake out, and therefore that was of course a fake out as well. So we did get a rejection on that, but that doesn't mean this pattern is invalidated. The descending wedge formation on the Bitcoin chart is very much still here. We do have that downtrending resistance, okay? We do have at least 2 retests. We have at least 3 retests, and that means this descending wedge formation has now been confirmed. It is completed. This is a complete pattern. We can tick it off. What does that mean? Well, it means with a higher degree of certainty, the next break of this downward trending resistance is going to be the reversal point in terms of momentum for Bitcoin, and thus the reversal point for price action. What we are noticing as well on the larger time frame is a very clear bullish divergence. We have a bullish divergence over here on the chart, and you can see that bullish divergence on the RSI over here. Bullish divergence being a rising RSI and a declining price. There's discrepancy between price action and momentum. Obviously, with rising momentum, we expect the price to rise. So therefore, when we see the price falling, we do have this divergence or this discrepancy. That generally leads to a uptrend or a continuation higher post divergence. So something to keep in mind on that one. So let's go ahead and get rid of all of that. And we'll go ahead and bring up our bull market support band. As you can see on the 7-day chart, we did actually get rejected from the bull market support band over here, which was around 21,000. Again, this was a very obvious rejection point. A lot of people were buying at around 20,000. A lot of people were buying around 20,800, 21,000, and we were saying very clear rejection point, very clear fake out point. This is it was very, very obvious, guys. We had basically a perfect storm for a fake out over here, and that is what we saw. We saw a very convincing breakout, okay, but it was a very obvious fake out looking back in history, and we saw a 26-30% crash from that point. So that was a very obvious rejection point right there. Again, waiting for that bull market support band to break is sometimes a great indication of a trend. It does indicate the overall macro trend and the strength of a trend. As you can see over here, when we are above it, we generally push upwards, and we generally are in this uptrend until we break back below it, and we can see it time and time again pushing through. Again, we're generally in an uptrend until we break, and again generally in a downtrend until we break, with the exception of these fake outs. That was obviously a fake out. This is obviously a fake out, but we are still in this downtrend that we've been in since, you know, November 2021. Okay, November 2021. Okay, so we are waiting for that to break on the larger time frame to be a little bit more convinced in the macro direction. That is one indicator you should definitely be looking at. Of course, we can bring up our moving averages again. The 50 EMA is another one we'll be waiting to break over. But here's the thing, guys, the 50 EMA is so far away from the price action over here, it does have some time to catch up. But there's nothing saying that we can't see a similar thing that we saw in 2019, where we had, again, this huge expansion between the 50 and the price action, and then we had this rapid inclination all the way back up to retest and break through that, flipping that trend. It is very possible that can occur. It is unlikely to see so soon, but again, it is definitely possible and something we should keep in mind. And the most important thing we're mentioning here is that 50 EMA is a pretty good indication for the overall trend strength and the direction of the trend. Generally, where we are underneath it, it does either indicate points of reversals in the trend or downtrends as a whole. If we go ahead and bring up some larger time frame moving averages, such as the 200, we'll go ahead and bring up the 200. Okay, there's a 200. We can see we are well and truly underneath the 200. Now, this is a bad thing, guys. We haven't actually seen the price action spend this long under the 200 on the Bitcoin chart in the history of Bitcoin, okay? And I've got a few theories for this, but I think at the end of the day, we have to just understand what moving averages are so we don't apply too much significance to them. A moving average, all it really is, it tells us what the average price action over a specific period of time is in comparison to the price right now, okay? That's what it tells us. It isn't a support, it isn't a resistance, it's just an average, it's just a median. It tells us what the price is, where the price is now in comparison to what the average price has been over X amount of periods, depending on time frame you're on and what the moving average you are on, okay? So generally, when we're above the moving average, we have more strength in the current price action in comparison to historical price action over that time frame as to what we do now. And when we're underneath it, it shows weakness in comparison to the average price action over the last X amount of periods, okay? So it's not a strong resistance, it's not a support, it's a place people generally look for entries on, but it's not a support or resistance, and therefore we shouldn't be worried too much that we're underneath it. Now, here's my theory. Yeah, this bear market, we've only seen a 75% drawdown, which historically we know we've seen 85, 86% drawdowns, but this is the thing. The percentage drawdown doesn't account for the displacement of money, okay? Displacement of money being the amount of actual dollars, the amount of money that has been removed from the market during the bear market, okay? For example, a 80% drawdown from a price of 20,000, okay, to 3,000 is less significant in terms of monetary displacement than a 75% drawdown from 70,000 to 16,000. Much more money has been taken out of the market in this move downwards than was taken out of the market in this move downwards. And that goes to the stock market too. Much more money has been displaced out of those markets this bear cycle than the prior one, even though the actual percentage drawdown has not been the same. And this is one reason why I'm not entirely convinced on every bear market needs to see an 84% drop. It is possible, but it's not theoretically tangible. If we see more and more money into a market every cycle, we can't see 84% drops every single time, because we're seeing the bear markets being more aggressive. Sure, the bull markets are getting smaller by percentage, therefore the bear markets should also get smaller by percentage as we have more money being put in and we have more money being taken out each cycle, okay, in terms of monetary displacement. So that is definitely something to keep your mind on, guys, when we are looking at the trend downwards. Let's go ahead and drop to a smaller time frame and just take a look at some other stuff. So smaller time frame, let's go ahead and bring up our Ichimoku cloud now in the smaller time frame. What we are looking at Ichimoku cloud, again, prices underneath the clouds over here, lag of span under the clouds, conversion line baseline under the above the price, not looking good, indicating a very strong downtrend. Moving to a daily chart, very much exactly the same thing, indicating a strong downtrend. Here is something I want to show you though on the monthly chart. And if we go ahead and get rid of everything but the conversion line, the baseline, sorry, and leave that up, what we can see is something very interesting. We generally see on the monthly chart over here, when we lose this baseline on the monthly chart, we generally enter a bear market. Okay, and when do we regain or start a new bull market? When we close that daily candle above that conversion line. As you can see over here, daily candle, monthly candle, sorry, above that conversion line, that is when we enter a new bull market, okay? So bear market over here, close the monthly, bull market. Bear market over here, close the monthly, bull market. Bear market over here, down, okay? It is quite a lagging indicator, of course. It is the baseline, and of course it's on the monthly, but it won't get you the bottom signal, but it will tell you when we are more confidently entering a bull market. So something very interesting to see, guys. The baseline is still quite high away. Again, it doesn't mean we can't push upwards, but what it does suggest, it suggests we do have a long time before we do enter a new parabolic bull market. And that goes hand in hand with that 4-year cycle theory, which does suggest we generally have around 12 to 13 bars between the tops and the bottoms, okay? And then we have generally on this about 16 bars from the bottoms over here to the breakout. As you can see, 16 bars. So therefore the next bull market should start according to that pattern around 16 bars from now, which is Friday, the 1st of March, 2024. That is when we should actually enter a new bull market. We will enter a new uptrend, okay? Remember, the uptrend starts at the end of the 12 bar. Okay, so according to the 12 bar theory, we should enter a uptrend here, but we won't enter a new bull market until 2024, about May 2024. So we do have quite some time over here before we enter a new parabolic rally upwards to wherever that may go. Okay, that is my opinion, guys. I hope you enjoyed the video. Let me know if you have any questions, and obviously we'll see you guys tomorrow for a new Bitcoin update. Cheers.